Hello, it's Neil Young here again from Elixir Energy, ASX-listed energy stock. I think I only spoke with you, Matt, about a month ago, but we've had some pretty interesting developments in our Australian and Mongolian gas projects since then. So look forward to telling you more about those.
Good man, Neil. It was actually the middle of September. Time flies when you're having fun, Neil. Time flies. Look, want to catch up. So it's sort of end of the year-ish, but we hadn't spoken about the contingent resource being booked on the, as it is now called, Grandis Gas project in Queensland, and it was quite a big step up for you. So I wanted to, well, maybe just tell people about some of the numbers, and I want to kind of get into it with you.
Sure. When we acquired this project in the middle of the year, we announced a prospective, i.e. an undiscovered resource at the time, and that was pretty substantial, 3 trillion cubic feet in the medium case. But our technical team continued to work on the open file data from the significant program that BG Group, now Shell, undertook about 10 years ago, and concluded that there was in fact a discovered resource here, given it's an unconventional play, and that one could legitimately extrapolate from those wells into our acreage. And we worked with independent global reserve certifiers ERC Equipoise, and that they agreed with us that the mid-case contingent resource was around 400 billion cubic feet, which is a pretty chunky number for a junior. That there was also some associated condensate or light oil with that, and pretty conservatively at this point, we assumed about 10 barrels per million cubic feet and booked just over 3 million barrels for that. But one of the objectives of our program will be to significantly increase the condensate ratio, the contingent resource, and all things going well, also booking some initial reserves.
Yeah, I mean, I thought it was quite interesting because the sheer scale of it, it almost feels like, and we'll talk about Mongolia in a second because I know you've been flaring there, so obviously some good news coming from there in terms of the commerciality of it. But the sheer scale of the opportunity here, I guess, is only tempered slightly by the fact that you're going to have to go deeper. It's going to be more expensive, and the kind of the risk component is there probably in people's minds. So what for you de-risks that project?
So this project's substantial factor of de-risking was in fact initiated by Mr. Putin. This was always known to be gas that was there from this 10-year-old plus type program, but it was known to be deep, as you say, fairly tight, and therefore expensive to produce. Now, when gas prices in Australia were in the $5 or $6 Australian dollar sort of range, this would not have been in the market. And when international gas prices were lower than they are just now, it would not have been in the market. But in our view, the war has permanently changed international gas market dynamics, both in terms of absolute pricing, which means that this can enter the market and be highly profitable, but also in terms of the premium that a safe location like Australia demonstrates to, for instance, East Asian or even European gas buyers.
It's interesting you say has permanently done so, because obviously I think with most investors being around long enough, you kind of see these cycles in and out and price moving, etc. But you feel that there's going to be a legacy issue, even if things do get resolved between Russia, Ukraine, and EU, UN, you name it. You think there'll be a kind of permanent effect on pricing?
Yeah, I mean, Russia is the world's largest exporter of gas, but the key thing in gas markets is that customers build a lot of infrastructure and invest a lot of money on the assumption that gas will be delivered in accordance with contracts. And when gas supplies are not honoured and pipelines are blown up and things like that, then it would take a very, very long time for trust to be re-established and for that gas supplier to re-enter the market in the same way as it did before. Whereas Australia, for instance, the North West Shelf, operated by Woodside, has been supplying for 40 years and never missed a cargo. And that sort of thing is extremely valuable. If, say, I'm in Japan and I've got to heat my neighbourhood next week, I don't want to feel that gas is not going to come.
So what do you think it's going to do? You talk about the sort of the pricing that you've been used to in Australia today. What do you think that could look like going forward? Are you putting, you're going to have to start evaluating the economics of this thing eventually, but you must have a sense of where you think this thing could settle.
So I think that Australian gas prices will be permanently above $10 Australian, and for the medium term, they will be probably considerably above that. And that doesn't reflect top-headed capitalists viciously gouging poor widows and orphans. It reflects the fact that cost of production has gone up, and that the easiest to extract gas has already gone. And that's just reality. Cost of capital has gone up as what I might loosely call ESG concerns have made it harder to access capital for the development of oil and gas assets. So that's the reality that we're in, and I think internationally, gas prices will be in the $15 or thereabouts sort of region for longer-term gas supplies, and for spot can be multiples of that. And clearly, we're seeing that in the European and East Asian spot markets just now. And unfortunately, I think this winter to date has been mild. Although you mentioned it was getting a bit cooler down in the south of England just now, and hopefully that mildness will persist. But I think it's not only a one winter issue, that the Russians could well extend this for multiple seasons, unfortunately.
So how's come at a good time for you? Actually, I'm just thinking about, you talk about cost of capital, but there's also rising costs as well. There's lots of factors sort of, squeezing margins for these things. So in terms of timing for you, this could have worked out quite well in the sense that you've got on with it. You've been able to kind of book the resource and hopefully some reserves coming down the line too. To actually try and understand the field, try and work at, because like I say, these are deeper holes, these are slightly more expensive holes, and they, the risk of getting dusters is always there. But you want to try and manage the field as well, and you've got to start somewhere. But starting in an environment like this is probably, as you say, Mr. Putin's done oil and gas sector a favour here.
It has, and it allowed us to lever the one significant competitive advantage we've got over much bigger companies, and that is that we can move quickly. Now, we've picked up an asset in the heart of territory that Shell and Santos dominate, and now why did we manage to do that is a question people ask. And for those people who haven't worked in big companies, they assume some level of efficiency which doesn't in reality pertain. These companies take a long time to decide to do anything. When they do, they apply money and expertise and do it well. Whereas our technical team had looked at this asset before. When the opportunity came up, we could move very quickly and deal with a sensible buyer who didn't have capital, but who got a good outcome from it with significant upside kickers. So that was great. And on our technical team, again, one feature of our industry is that every 10 years, anybody who costs a lot gets sacked from big companies. So what we can access are people with 30 or 40 years experience who are consultants, who aren't working for the big companies anymore, but who have enormous experience. And if you can combine the right team, which we think we did, then that allows us to, with confidence, acquire an asset, and then as we noted in terms of the contingent resource, actually work with an international certifier to confirm a large resource that is in fact present.
And you talk about, so obviously reinterpreting and reanalyzing some of the historic data that you've got available to you, but you've also got a major working close by whose data you can look at. Presumably you can look at, I'm assuming you can look at, plus also some of the service companies that they work with give you, which you'll be working with too, which gives you, again, a modicum of comfort around the risk component.
Exactly. Working where someone with a lot of capital already is indicates that in a success case, when you want to access capital, be it from the markets or be it from larger industry companies, then it should be available. The likes of Shell have been very explicit in that they won't be going to new areas. Well, it doesn't bother us. We're already in this area with them. Then the second issue of service companies, Our philosophy here is very simple. We will, to the extent we can, pick up the same drilling companies and other service companies that Shell will be using, and that has the advantage of lowering risk. It means that we will use what's called a hot rig, which is not quite the shape of my body anymore, but rather a rig that it knows what it's doing in a particular region, and can drill quicker and with less risk, because the crew and the equipment is all honed in. So that's really a big advantage here. We anticipate, subject to locking those contracts in, being able to drill in around the fourth quarter of next year. And this will be a significant well, and in fact, arguably the most significant well that the company's ever drilled, and it was initially listed, nearly 20 years ago.
Yeah, well, that is saying something, and I just want you to kind of help me understand how you envisage creating that value, right? Because I mentioned reserves there a second ago, and obviously the ideal situation is that you can build those up. How does a company of your size go about, I guess, engendering some degree of confidence with the financiers? What are they looking for? Because having 3C numbers is great, but let's bring more certainty into this. Let's bring some comfort around the targeting of where these drills are going, etc. So, what are the variables that you look to focus on?
So, I think a critical one, which touches a number of those points, is bringing in a partner, and we are highly confident that we can do so. Now, clearly that defrays costs, and hopefully to a very significant extent. Secondly, if they are a bigger partner of substantial credibility, which in this instance we believe can be the case given the desire, for instance, of East Asian energy companies to own molecules in Australia, that the fact of them coming in validates the technical quality of the play and the team and the future for the asset, and then also provides an avenue to pursue future funding, not only from public capital markets, but from such industry sources. In terms of being a listed company, we obviously like to generate news flow, and we anticipate a very nice build-up over the next 10 or so months of securing the same rig as our neighbours, securing other service sector providers, locking in the particular spot, although we want to drill, although we're pretty confident we've got that already, bringing in finance through farm-in. And indeed in Australia there's another form of finance here, and that is what's called an R&D credit from the Australian Tax Office, which for this type of play can fund nearly half the costs of a well. And so that's pretty a significant credit as well. And so, yeah, we are pursuing numerous angles, and we think that will be a very nice run-up of news, which the market will welcome and the industry will welcome into the drilling of what will be an appraisal rather than exploration well in Q4 next year.
Yeah, I mean, to that point, you do put out a lot of news, but it seems, from an investor's point of view, very sort of administrative focus. Like, the exchange requires you to put out information as opposed to, here's something which anyone is excited about, or here's something that means we are more likely to move, this thing forward. Do you know what I mean? And some of the things you've described there are super, and it'd be great to sort of see a bit more of that next year. I suspect, and obviously money, you're good, right? You've got a stack of money, but you can burn through it quite quickly. So again, if you're prioritising your allocation of capital, what does the Queensland project look like in relation to what's going on in Mongolia? Because you have again had some, like I said, you talked about flaring has happened. First time in country, or first time for you in country?
Well, yeah, both. I mean, we have been the pioneers of CBM exploration. Thanks. In Mongolia, we commenced just very recently an extended pilot production test for the first time, and that saw gas break through very, very quickly, which reflects the highly gas-saturated nature of the coals in the region. More gas means less water, which means lower cost and quicker flows. Now, we'll continue to flow that gas for a period to be defined, but could be a few months, to get a stabilized rate, which we believe will establish commerciality, and then we can book reserves. So until that's done, though, our options in Mongolia are got a few forks in the road, and but do we develop that particular spot, or do we explore and appraise elsewhere, or do we do all of the above? And we'll certainly be aiming for the latter, but keeping our powder a little bit drier until the former is clarified. And then as and when we close out the financing outcome, which we believe was likely to be a farm in Queensland, and that will liberate deployment elsewhere in our portfolio, i.e. to Mongolia.
Right. And just to understand a little bit more technically in terms of you're kind of looking for a kind of steady state. So you've got to run this thing for a while and see what the decline looks like. And indeed, I guess you'll see what the decline looks like over, the next few, weeks and months as well, because I'm not quite sure, because, you are innovator in country. There's no one else to kind of look to more in terms of trying to work out what that could look like. What's your expectation, though, of what that decline rate looks like?
So in coal seam gas, we expect a build up first, and then a period of steady state, and then a decline. But as you say, because we're the first people to do this, we don't have analogues. I mean, if we were in Australia or the States or whatever, there'd be hundreds, if not thousands, of wells, and you'd establish whether you were on the successful type curve fairly readily. Here, we're establishing the first type curve, and so we will carefully look at it, 10 times a day as we go forward. Access the collective brains of our team and our reserves certifiers, and then get to a point in, could be a month or so, or it could be slightly longer, where we go, okay, we have now established a commercial flow rate which is sustainable from this, and we can turn off the flare, and that we will know that we can now book reserves.
It's kind of interesting to me, because I know you don't have any in-country analogues, but are there geologically other analogues that you can look to and say, because you're going to be saying, right, okay, if the decline is quite steep and quite quick, we're going to need multiple holes. We're going to need multiple drilling rigs. We're going to need to see how we manage these manage this field, and why, because it's also quite big. But you must be sort of thinking it's a little bit like X, Y, and Z. And I don't know what that is, because you wouldn't be walking into this if you didn't think you could make money, clearly. So again, what expectations?
So I think that the closest analogues technically are in China itself, and which obviously it's proximate, so it has some geological similarities. It also has the similar issue that costs are low, if not very low. And reserves bookings are really a function of the intersection between flow rates, prices, and costs. I mean, they're not, it's not constant around the world. If you're in a high-cost environment, then your reserves booking, hurdle is significantly higher. But this is a low-cost environment, and then that Chinese connection is also relevant to our view that in the longer term, development capital will likely come from China itself, from those companies who are highly experienced in dealing in similar locations inside their own immediately neighbouring country.
Right, and by that you're talking about infrastructure, because this is the whole thing. We talked about Putin earlier. It's very easy saying, the gas is going to stop flowing west and start flowing east, but you need that kind of infrastructure, pipeline, etc., and it just takes some sort of time. So again, in terms of what you're going to be able to signal to the market and signal to some of these capital expenditure funders, what do you think that needs to be? Because clearly scale is important to this thing, but so is timing.
So I think the fact that we've gone from concept to discovery to appraisal, and then hopefully within months to establishing commerciality, in what in oil and gas terms is really a short period of only a few years, is something that will grab the attention of even very large companies, because these things don't occur very often. The other factor to consider is security of supply, and everyone's got a different perspective on this. If I'm a Japanese gas buyer, I'll see Australia as being secure. If I'm a Chinese gas buyer, I'll see Mongolia as being very secure, because it presents no geopolitical threat to me at all. Now, even if I might be best buddies with Putin, but I don't necessarily trust him. And I also realise that the cost and timing to bring gas that is currently pointed towards Europe, but which is probably not going to go there in very big quantities anymore, to take that in effect to East Asia probably requires $50 billion in 10 years. And then do I trust them, and how much am I prepared to pay, and all those sorts of things. Whereas again, if I'm a Chinese company, I go, well, it's just next door. The infrastructure costs are accordingly substantially lower, and I'm not going to have my supplier blowing up a pipeline.
Yeah, no, I can see that. I mean, it sounds like 2023 is kind of, pardon my French, pardon the pun here, but you're priming the pumps in the sense that JV or a balance sheet partner in Queensland would hopefully happen at some point there with a project which is meaningfully big, and that's good. What's happening in Mongolia is starting to sort of signal to potential end buyers and infrastructure funding partners that it's moving along quite nicely. So again, what's your expectation of the scale component to what you're going to need to signal to the market from Mongolia? I know you've got a big vast tract of land, but you're going to need to put how many more wells and how much more money, and will you need to be raising to do that, or do you think there's a sort of alternative to equity financing?
I think in Mongolia, it's the fact that we've established a process that moves from exploration to appraisal to demonstrating commerciality is what's important, and that will bring in capital in the form of a partner or an acquirer or an infrastructure provider, as you say, without material risks of dilution to ourselves. When we don't need to pepper our block with wells, we think we've now established a process that works. Of course, in Mongolia, we can't ignore our longer dated and potentially enormously scalable green hydrogen project with our Japanese partners, SB Energy, and that's also a source of substantial change in 2023. We signed an MOU with SB Energy in the middle of the year. Now, all things going to plan, we would like to convert that into a binding joint venture in some shape or form in the first half of next year, and doing so is being built on the pre-feasibility work that we've been doing on multiple fronts, and which looks very promising.
It's kind of interesting, actually, the Gobi project with SoftBank or SB Energy, I think it is, isn't it? Because what we're seeing in the mining sector is the fact that some of the large companies, I'm talking the Rios and the BHPs and even some of the mid-tiers, Newcrests, Newmonts, etc., they are starting to move back upstream on the exploration side. And I think it's kind of interesting that budgets have not been there for a couple of decades, quite frankly, and now we're starting to see that with the oil and gas sector. Again, we've all companies in oil and gas have had a torrid, we'll call it a decade, because it was even before Mr. Putin trotted into Ukraine. Are the bigger companies looking to smaller companies to try and get involved earlier, or is there still that well-trodden path of you find it, you prove it, and then we'll come a calling?
I think it's largely the latter. There are new sources or new-ish sources of capital. So we've seen Australia just now take over a company called Origin, and it's a vertically integrated energy company, and private equity is basically taking the upstream part, because it believes that public markets aren't adequately funding oil and gas, and that provides it with an arbitrage opportunity to come in, pick up assets that, for what it believes to be false ESG reasons, aren't loved, and can make a healthy rate of return on those. And I think the success of that strategy will engender vast pools of, in effect, non-public money to seek out similar opportunities. So there might be less chance of bringing an Exxon into something, but there could be XXX private entity, private venture company that will come in instead, because capital finds ways to make returns, and if particular ways have obstacles, then that pool of money flows through different means to try and find those returns, and we're already seeing that, and I think that will continue. I mean, the oil and gas isn't tobacco. It is an absolutely fundamental requirement of humankind, and sure, putting CO2 into the atmosphere, creates a greenhouse effect. I don't dispute that, but the reality is that the two things need to operate hand in glove. It's not one thing is good and one thing's bad. There needs to be a synthesis between the two propositions, and that's, I think, now coming. And that requires, obviously, CCS and DAC and other mechanisms like that, which means that the gas in particular has got a multi-decade role, and capital will finance that in ways that makes a return for itself.
Okay, so and I think that's an important point to make, because I think there are people sitting both sides of that argument. Clearly, I think people are making a lot of money off oil and gas project investments at the moment. I'll even throw coal in there. I think even more so with coal. But it's very sort of high profile narrative in the market about this anti-fossil fuel discussion going on, and which is being had in the context of, well, if we just switch it off, I think the world's in a whole bunch of other issues. The sort of knock-on effect is huge. Do you think that the oil and gas industry is handling it the right way, or trying to educate, or just ignoring it? Because the media has kind of picked up on it. Some very high-profile images of people just sticking their hands and their faces to walls and throwing paint over, art galleries and car showrooms, etc. So there's a lot of noise. How can you operate in that environment, and how do you think that's going to affect your ability to raise capital or find the partners that you want going forward?
I mean, it certainly constrains an ability to access capital, but therefore I think our entire strategy recognises that. We pick projects with the view, if we're successful, how do we get capital? And so our Queensland project is in an area that has been blessed by super majors and blessed by customers, and accordingly we can see a clear path from successful appraisal to finding capital to develop. Our Mongolian project also has a view that development capital will come from China for political and economic reasons, and so that's well thought out. On the hydrogen side, the amount of capital wants to find a home is just enormous, and we think a good project can, and in our instance already has, attracted a very high quality partner to fund things. So strategy has to almost be set backwards. We're saying, don't explore and then expect the world to come to you. Work out, if you do explore, how the world is going to come to you, and then pick the place you're going to explore and how you're going to do it that's going to fit that objective.